Karani Health Agency, Whole Life Insurance Series 2, Universal Life Insurance. With life insurance, it pays to get started early. Protection for your family. Life insurance is important. It can help you protect your family, but there's a lot to consider before settling on a policy type. If you like the flexibility and the potential for cash growth, you might decide that universal life insurance is a good match. Universal life insurance is a type of permanent life insurance. Unlike term life insurance, which is written to cover a specific period of time, universal life insurance can provide lifetime coverage. Universal life insurance provides the certainty of permanent coverage while maintaining the flexibility to meet your family's changing needs. Life insurance is there to protect your savings and guarantee that you leave something to your loved ones after you die. You deserve a policy to protect what you already have and build value without exposing you to unnecessary risk. Beyond the death benefit, the cash value. Life insurance provides a death benefit that is paid to beneficiaries upon the death of the insured. This death benefit is what most people think of when they consider life insurance. If you already talking about term life insurance, death benefit is the whole point of purchasing insurance. Universal life insurance, however, is different. Although the death benefit is an important part of the coverage, for many policyholders, it's not the only element. In addition to the death benefit, universal life insurance builds a cash value. This cash value accumulates interest, and the cash value growth enjoys a tax-deferred status. Once the cash value reaches a certain level, the policyholder will be able to access it by withdrawing funds or by borrowing from the policy. Loans are typically not taxed. If a loan is not repaid, the death benefit will be reduced. Universal versus whole life insurance. Whole life insurance is another type of permanent life insurance. At first glance, universal life insurance and whole life insurance can seem pretty similar. However, there are some key differences, and many of these differences come down to the flexibility and risk. While whole life insurance has fixed premium, universal life insurance has adjustable premium. By paying more, the policyholder builds up a larger cash value. Because the cash value accumulates, the interest that can be used to pay premium in the future or withdrawing or borrowed as needed, this can be desirable. When funds are tight or after reaching retirement, the policyholder may be able to decrease the premium. The policyholder may even be able to skip premium payments. It is important to make sure that the premiums are sufficient to keep the policy active. But if a sufficient cash value has occurred, the cash value can be used to cover the required premiums. With universal life insurance, the death benefit can also be adjusted. This is flexibility can help the policyholder manage changing needs. Universal life insurance policy variations. Universal life insurance is one type of life insurance, but policies aren't all the same. There are actually different types of universal life insurance policy. These differences can be substantial, so it's important to know what kind of universal life insurance policy you are considering buying. The advantage of universal life insurance. Many people consider universal life insurance to be an attractive option because it offers the following advantages. The policy builds a cash value that can be accessed during the policy's life. For example, through a loan or withdrawal. The policyholder can adjust the premium payments as long as the payments are sufficient to keep the policy in force. If the market performs well, the cash value will grow accordingly. This can result in substantial gains. The death benefit can be increased, providing a greater benefit to the policy heirs. Cash value growth has a tax-deferred status. Life insurance policy loans and death benefits are also typically tax-free. The disadvantages of universal life insurance. Although the flexibility of universal life insurance can be attractive, there are some downsides. Before purchasing a universal life insurance policy, it is important to consider these disadvantages carefully, as some of them could result in the lapse of your policy or a reduction in benefit. The policyholder may need to pay various fees before purchasing a policy. Understand the costs involved. Market losses may reduce the cash value. This can result in substantial losses. The death benefit may be decreased. This means you might leave your heirs with less than you inherited. The policy will lapse if the premiums are not maintained and there's not sufficient cash value to cover the missed premiums. How does universal life insurance work? Access to cash value. Universal life insurance accumulate cash values that earn interest at a current rate with the safety net of a guaranteed minimum rate. The policy cash value grows on a tax-deferred basis, so earnings can be built up faster. If needed, you can borrow against your policy cash value or make partial withdrawals, usually for any needs that may come up, such as emergency, college tuition, supplemental retirement income. For a free consultation, call 224-433-5754 or go to www.camaraderiehealthagency.com. You connect with us on LinkedIn, follow us on Facebook, subscribe to our YouTube channel.